Okay, recording is in progress. I think I got to mention this is a follow-up, as Jessica shared, to David and Jeff's third founder discussion on operating in a downturn. So in terms of agenda, we'll spend a bit of time recapping on the December 16th content, so we're on the same page. Then we'll dive into the 8 actionable items to help drive operating efficiency in this time of pretty heavy headwinds. And then throughout, we'll be talking about strategic finance and budgeting tools that should help you in the process of forecasting for next year. So let's dive in. To kick things off, we're going to rewind back into Q4 of 2021. And I want everyone to think of yourself and your company as this plane. And the plane angle is representing the burn multiple. So last year at this time, there was a lot of capital availability. It was all about high growth at all costs, and burn wasn't really something people focused on because of the capital availability, and you could just raise quite quickly. So that's where we were this time last year. Now, since that time, there's been a pretty big correction in public markets and also in private markets, which tends to follow what happens in the public markets. So just quickly, high level, we saw a huge decrease in Q1, Q2. Valuations for high growth SaaS is down about 71%. And when you look at Cooley data, the average private valuations are down similarly in the later stages in series sort of C and D. The other thing that's really important to call out here is there's a new emergence of what matters for valuation. It's a new paradigm. Used to be all about growth, and now it's all about growth, efficiency, unit economics, and profitability. And companies that are living in the old world and are still burning a lot and growing a lot are actually getting punished in the public markets. So based on that, we're back to our chart. In Q2, Kraft had a discussion and sort of shared, be aware of this, and you might want to extend your runway. And a lot of companies did exactly that. So you can see that the burn multiple, the steepness of that airplane is leveled out a bit, and everyone has extended their runway. And that is important. And now there's something new. Something we didn't see in Q1 and Q2 that occurred in Q3 is a pretty dramatic slowdown in demand. Just quickly on Salesforce, they added 1.1 billion in Q2 this year. And in Q3, it was 360 million. And when you don't adjust your S&M to match that demand, your CAC payback goes way up. And that's exactly what happened to Salesforce. What's interesting is not only is that happening to Salesforce, but to pretty much every other software company. This is looking at net new ARR growth over time. And in Q3, it went down. It was negative at 13%. And what's alarming is in Q4, it's supposed to be even worse. And definitionally, when there's 2 quarters of negative GDP growth, that means there's a recession. So I guess you could call this a SaaS recession. And the highlight is that it's happening to everyone. So the demand contraction is real. The last data point we looked at is these are the top 10 highest trading software companies. Last year, they grew around 60%. Next year, their forecast is to grow on average 32%. So the expectation for growth is down 50%. So again, that supports the idea that demand headwinds are real and we should plan for it. So here's our chart again. And you basically have 2 choices, and there's really only one right solution. But one option is to maintain your current cost structure and your growth rate. And with headwinds, what ends up happening is your efficiency metrics go down and you run out of cash. So that is a crisis scenario. The more pragmatic and the only right option in this case is to weather the headwinds and ensure your company is at maximum efficiency. And that's what we're going to talk about today. And just quickly, I think it's important to call out that investors and VCs understand this. They understand that it's much harder now to grow than it was last year because of these headwinds. And the most important thing to do in the next number of quarters is to adjust appropriately to ensure that your efficiency metrics remain as they are. You have around 24 months of runway, and that your burn multiple ideally stays under 2 and closer to 1. And we'll dive into all this in more detail. But finally, before we dive into the 8 things, I think it's important to call out what the goal is, which is to set yourself up for success. If you don't do anything, 1, you run out of cash sooner, but 2, your metrics look really, really rough. And when you go back to market after the recession, investors will look at how your metrics trended during the tough times. And if they didn't trend well, that's not a great sign. If they see that your metrics looked good and you adjusted accordingly, that's going to be a win for you. So the goal is, by the end of this, you have really focused on your company, you've driven great efficiency, you've bulletproofed your plane, and your plane is now a fighter jet. I recently watched the Maverick movie, and obviously it was great, but that is the goal. Set yourself up for success and focus on sustainable efficiency. So let's dive in to the 8 things you can actually do today. And these are all very actionable items. We're going to go through each one, and maybe all 8 are not relevant for you. Maybe 2 or 3 of them are. And the goal of this discussion is to inspire you to look into these 8 things and ideally identify areas to optimize. So I'm not going to call out all 8, but they are specifically designed to drive efficiency across your entire organization. 1 to 4 is go-to-market focused and oriented around driving sustainable sales efficiency. 5 and 6 are all about the OpEx side of things below the line and will help you drive operating efficiency. 7 is related to people and culture, which is really important in this time. And then 8 is king. Cash management is so important, and you don't want to be in a situation where you're surprised and you have to raise when you don't want to. So these are the 8, and let's dive into each one. So the first one is hyper focus on churn mitigation. And what you can expect in tougher times are headwinds on your churn and on your metrics. So with headwinds, churn goes up, downsell goes up, and then your expansion, it's harder to expand. So there's a couple of things to call out that are really important for why this matters. Firstly, is it's 5 times more expensive to acquire a new customer than it is to maintain a customer. I'll quickly run through some math on this. So if you had a plan for next year to go from 10 to 20, that's a 2x. And in your plan, you thought you were going to churn 1 million and you're going to expand 3 million. So your gross dollar retention would be 90%, net dollar would be 120. Now, because of the headwinds, what ends up happening is you churn more than you expected. You churn 3 and you expand less. So you only expand 2 million, which means you have a $3 million shortfall. Now, assuming the same win rate that you had last year of 25%, that means you have to generate $12 million of additional pipeline. And that win rate in tougher times might actually be lower. So that means you even need more pipeline. So not only do you need to spend the extra money to get that pipeline, you also then need the reps, you got to pay commission, and it just becomes way more expensive. So the goal is to save the customer versus replenish. The other important metric and call out is when churn increases and there's headwinds, it gets seen across every relevant SaaS metric. So here are the key metrics that really matter to investors. These are the formulas. The red represents where you can see how churn impacts, whether it's reduced expansion or increased churn and downsell. But this is important to call out, similar to what I was saying earlier. By the end of this recession, investors will look at the metrics and they'll want to see healthy metrics during this time, and they'll benchmark how your company was versus others. So it's really, really important to try to drive great metrics and be focused on them. So that's the context on why it matters. And now let's talk about what you can do. So overall, you should be maniacal about keeping your ICP customers healthy. Always go the extra mile to save your customers and get creative. So in terms of what you can do right away is first sit down with your team and think about all the churn trends. Why did customers churn? What were the reasons? And then based on those reasons, brainstorm short-term solutions and long-term solutions that can reduce those risks. So on the short-term side, implement all those right away, and then longer term, assign those to specific team members on the CS side, and then have those solutions implemented. The other thing that's very helpful to do is a churn mitigation war room. When I helped the company in the past, we launched a churn mitigation war room, and it ended up saving a massive amount of churn. So what you do for this is you map out your customers and you create a list of all the customers that are up for renewal next quarter and the quarter after. You then assign a customer health score to all those customers, and you can see, okay, here are all the customers that are up for renewal and are in the red zone. And the goal is to convert all of the red zone that are likely to churn into yellow and then into green. So once you have that list, you then get the executive team together and you get creative and you come up with a solution to save. So in the case where I helped that company, the founders ended up flying on site with those enterprise businesses, met the whole team, and they saved 3 of the customers, and that ended up being over $1 million of ACV. And they all sort of said, if we didn't do this, I don't think we would have saved it. So get creative, be maniacal about keeping your ICP customers healthy and happy, and that's the first one. We will save questions till the end, but launching in to the second one, you might be wondering what this visual is on the right, and it's about nutritional choices. Perhaps the left is the food you ate over the last 2 weeks during the holiday. I sure felt that way. And on the right is ideally what you might be eating based on your New Year's resolution to be more healthy. So why is this relevant? It's the same thing as we think about our customers. Just like as you think about calories you eat, if you ate a year of junk food, 2 or 3 years later, you might run into issues. In software, if you're just trying to win all of these different customers and you don't really care about whether they're good for your business or not, down the line, you might run into issues. So we're going to talk about 3 stories and what to do and how to figure out and prioritize segments, verticals, and geographies, and assess which ones are best. So here's another example. I was working with a company a couple of years ago, and they were selling globally across 23 different verticals. And we pulled a whole bunch of different metrics that would help you assess if a vertical was healthy or not. Growth rates, retention rates, ability to upsell net dollar, gross margins, win rates, sales cycle. We pulled it all together and looked at it. And we basically said, okay, some of these customers are really healthy, just like kale. Other customers are not. And let's just focus on customers that are really healthy. So when we did this, we deprioritized with the company I was working at 18 of the 23 verticals, and we just focused on 5. And over time, all the metrics of the business improved because the customers they were focused on were very healthy. So that's the first thing to look at, your verticals you're selling into. The next thing to look at is by segment data. So same thing, pull all the data and look at retention rates, LTV to CAC, which is helpful for sales efficiency, CAC payback. Talk to your sales team, assess, what they think is easiest to sell to, look at the sales cycle time, and basically do the same analysis. And what you'll see is certain segments are really good and certain segments are not. In this case, this was a company that was selling into sales teams. They were doing a great job selling into the enterprise, and that was super efficient. Same with the mid-market. And unfortunately, SMB and micro SMB was less efficient. And in terms of dollar retention, was not as healthy. So we looked into this and we realized that the go-to-market motion and the implementation journey for an enterprise was being used for customers that were in SMB and micro SMB. And that is not efficient. So, the lesson that was learned for this company is if you have an enterprise go-to-market motion, sell to the enterprise. Don't have an enterprise go-to-market motion or onboarding process for an SMB account. And if you don't have an ability to do a self-serve option, then the best thing to do is have a minimum ACV threshold to ensure that every customer you end up acquiring is efficient. So that's the second story. And the third one's very similar, but it looks at it by geo. And I'll cover this quite quickly because it's the exact same analysis, but this was another company I was working with in the cybersecurity space. They were selling globally, and their product was ready in the Americas and slightly ready in EMEA. There was amazing product market fit in North America, though. And what you can see based on the data is in APAC and LATAM, there wasn't product market fit yet. So we adjusted resources to the more attractive territories and geos, and that drove really strong efficiency and improved CAC payback. So just to quickly summarize, prioritize best geos, segments, and verticals. And it's important to call out that with these headwinds, you might pull all that data we just looked at and things might change. If you're really good at selling into micro SMB, typically micro SMB, unfortunately, experiences challenges when there's headwinds and in a tough cycle. So just be aware that these things might change and be ready to adjust very quickly. So that is the second thing to look into. And now we'll move on to the next. Excited for questions at the end. So the next is amplify your sales execution and optimize your sales process. It's unfortunate that you can't control headwinds, but that just is what it is. What you can truly control is the execution of your whole company and specifically in sales. So we just talked about going deep and understanding what your ICP is and also which customers are best. And there's a chance that you might not have a stringent enough qualification process. And if a third of your pipeline is advancing to the next stage in your sales cycle, but it's not actually your ICP or it's not a good customer, that is a huge hit on efficiency. So step one is revisit your qualification process and make sure, one, it matches to your verticals you're going after, but two, it's really stringent, because if anything gets past that first discovery phase and reps start working it, and it's just never going to be an account, that's a customer, that's just super inefficient. The second big thing to do is implement pipeline cleanup and report on this. Everyone might already be doing this today, but this is really important in a time of slowdown. We saw with Salesforce that quarter to quarter, their bookings went down from 1.1 to 360. And if that happens to your company and you have the same sales team, then your CAC payback and your efficiency metrics are going to go through the roof, and they won't be efficient. So it's very important to think about your pipeline, track the stages, track the conversion rates, track the duration in each of the stages. And if you start to see some slippage, start to adjust the sales team so it matches. Or if you don't, you just sort of know that your efficiency metrics won't look good. So that is the call outs on amplifying your sales execution. I won't cover this in detail, but we included it just as a read through. The one thing that's new on this slide that I didn't talk about is for next year, it would be pretty helpful to forecast and think about having your sales team at 100% attainment. And in the case that demand doesn't slow down as fast as you thought, they're going to overachieve. But in the case where their demand slows down more than you expected, they'll be around 80 or 90%, and you'll still have decent metrics. All right. Number 4, assess the go-to-market organizational structure with sales efficiency as the number 1 priority. So I'm going to paint a picture, and I'm not sure if this relates, but say you're in a boat and the boat is got way too many people in it, and the driver accelerates and the boat just goes into that stalled stage where it doesn't plane and just slowly goes and drives through the water. That is a helpful analogy as we think about go-to-market organizational structure. So if you look at your data and you have really high quota attainment, that's great. But if you then look at your CAC payback and it's not healthy, then there's some things to look at. And one of the things that might be causing this is your AE to support ratios are just not aligned. And we'll go into an example of this. The next might be that some of your AEs are, fantastic and way above their quota, but a majority of your AEs are below their quota. So look at that data. And then it's really important to look at the marketing and assess, based on all the dollars going into marketing, is that truly driving leads that are closing quarter to quarter? So look at these 3 things and have the maniacal thinking around every dollar that goes out for S&M, what's it bringing in? And if you can't attribute dollars going out and what they're bringing in, you're just sort of shooting yourself in the foot, because you just know that those dollars may be wasted. And that is a tough thing to have when you're in these challenging economic environments. So let's go through some examples, and then I'll talk through one of the budgeting template tools that you can use, which I think is important. So simple math to set up a sales team. Just quickly, if we all started a company and you had 1 rep, and that rep was paid $150K OTE, and you hired 2 BDR reps to generate pipeline, and in 1 year that rep closes 100% attainment, they book $750, that costs you $350, and your ARR CAC payback is really good at 5.6 months. So that's a great outcome. So now you start to scale, and you add more AEs, you add more SDRs, you add a sales manager, marketing, a bit of customer success is involved, and you then do the same analysis. And at 100% attainment, you're now at a 12-month CAC payback. And that's because every dollar that was added didn't necessarily contribute to bookings. So as you look at your cost structure, understanding what is quota carrying OpEx and what is not quota carrying OpEx, and reviewing all of the OpEx that's not quota carrying. And if you remove anything that's not quota carrying and isn't driving or helping the sales team, that's going to drive efficiency. So I was helping a company a couple of years ago. We did this exact analysis. Their sales team was hitting around 65% attainment. Their CAC payback was around 30 months. And we did a deep dive, and the manager ratios were a little off, and a lot of the marketing spend, unfortunately for that business, wasn't driving closed deals. So when we did this analysis, we realized, okay, well, if we reduce marketing a little bit and think about that manager ratio, what's going to happen to CAC payback? We modeled it out. It seemed like it was going to get better, made the changes, and within a quarter, CAC payback went down by 50%. And then the quarter after that, it was in the 12-month range. So as another lesson, look at all the OpEx that's quota carrying and all the OpEx that's not. Review the OpEx that's not quota carrying, and try to assess if there's ways to optimize that. The last thing I'll call out here is, in the old scenario, I was 100% attainment. But in a slowdown, what tends to happen is attainment also goes down, which has a direct correlation with CAC payback going up. So that is some simple math and some lessons. And now we have a lot of numbers on a page, but I think this is a really helpful framework, and it has been very helpful to me as I've gone into some of the companies I've helped. And think about that. Maybe I'll just go back to it. If you were racing in this sailboat, you have sort of one driver. I don't know who's managing the sail, but there's a lot of people having a good time. And the boat is, basically sinking. If you want to go faster, you have to remove those people. So what this analysis looks at is the sales pod profitability at a region level. And what I'll just walk through it because I think it's helpful. So this is an example company selling into America. They are, and it's an enterprise go-to-market motion, $1.5 million quota. You assume 80%. Quota to OTE is 5x. So in terms of top line revenue or bookings for that sales pod, going into the year, you have 1.2 million. You then assume the 85% gross margin, which gives you around $1 million of profit. Now you start to take off all the costs that are supporting that rep. So first is the expense of that AE. Great. Then you take off the BDR expense on a per AE basis. Same thing for the SAs, same thing for the channel. And you see your ratios on the right. Then you do what else is supporting the rep. You look at the managers, the CRO, and the VPs, and you take that off, again, on a per AE basis. So then what you can see is after the core sales pod expense and leaders OpEx have been removed, this sales pod is still profitable at 458,000. Then you take off customer success, CMO, marketing, everything else, and then you get your fully loaded sales pod profitability or loss on a gross margin adjusted basis. And for this scenario, it was profitable at 149,000. And this company had about 30 reps. So if 30 reps are closing around 80%, you know that they'll be generating profit. You can then do the CAC payback on that. And then also you can do the attainment that's required to get to 12 months CAC payback, which is a really good question to ask. And in this case, it was 68%. So if this company is going into headwinds, they know they have some room to miss. And if they've been hitting 80, 90% historically, there's a lot of room to ensure that they're still efficient. So we're going to look at this exact same analysis, but for the same company, but the sales pod is in Europe. And let's first look at the ratios. So these were the old ratios for the Americas. BDR, it was 2 AE to 1 BDR. And now that's flipped. There's a lot more BDRs to AEs. And that's the same across the board in terms of support. I'm not going to go through that same walkthrough top to bottom, but the summary is in Europe, product market fit isn't as strong. So the quota is only 1 million. You assume an 80% attainment, take off all the costs. And for every AE that's hired in Europe, you're losing $528,000. So that's just really hurting your consolidated CAC payback, and it's not efficient. The other thing to call out is here are your CAC payback numbers. And in order for this region to be at 12-month CAC payback, the team has to hit 142% attainment, which is pretty much impossible, unfortunately. So there's two things you can do. One, assess all these metrics and ratios and maybe adjust them. Or two, recognize that maybe Europe isn't ready for this product yet and deprioritize that market. And this is back to that earlier analogy of looking at all your geos. In this case, unfortunately, I think Europe should almost be deprioritized if efficiency is the number one thing that matters. And in a recession, that is basically the most important thing. So we can go deep on this in the questions. We'll also be sharing templates for this, which hopefully helps. But that is the walkthrough of the sales pod profitability analysis. Then the last thing, and I already sort of covered this, is a huge expense in your go-to-market team is marketing. If you're spending a lot of money on marketing and you do an analysis of, okay, what are all the closed deals from last year? and which deals were sourced by marketing and where'd they come from. That will, one, help you really understand where you should be spending the marketing dollars. Only spend marketing in channels that are working. But two, it will also explain and tell you if you should reduce marketing overall. There's a chance that all of that marketing spend, unfortunately, isn't driving a lot of bookings. And in that case, in the near term, you should reduce, fix the problem, and then start spending money again, versus fix the problem as you're spending money, because that's, again, just dollars going out, not driving any ACV bookings, and then your metrics, sort of fall off a cliff. All right. So that was a lot on top line. Now we'll spend the next couple of minutes going on sort of the bottom line, culture, and the budgeting side. So on the R&D side, the best thing to do is work with your CTO, map out the roadmap, and the features that are on the roadmap that are driving revenue or reducing churn are what really matter. And ask the CTO and the team to actually create a forecast for every single product. Okay, if we do this, what's going to happen? Maybe it increases our win rate. Maybe it reduces churn by 5%. Maybe it's a huge expansion opportunity and we can sell this across the entire customer base. And that means it's a $3 million ARR opportunity. So map out and apply a dollar value to every single R&D, every single project on the roadmap. Then ask your CTO to do an estimate of the cost. So once you have the estimate of the cost, you then know the ROI. And from there, you can then prioritize which roadmap items should be done right away and which ones can be pushed off. So that's one thing to do. And then the other thing to look at is focus on reducing hosting costs and automating manual process in the customer journey. So I've helped companies in the past where the onboarding process was very manual. That was really hurting gross margin. And when you care about efficiency and your gross margins are really low, that is just a huge problem. So what we ended up doing, this was a few years ago, but we automated that onboarding process with tech, which made time to value much faster for customers, and then also allowed that business to recognize revenue and cash sooner. So that's the other thing to call out. G&A is the next item, and it's unfortunate, to say this, but it sort of is what it is. G&A is one of the areas that has the most bloat in times where you're sort of growing at all costs, throwing people at the problem. And then when there's headwinds, all of that OpEx that is not quota carrying and is in G&A should be reviewed, because unfortunately certain departments and functions become redundant. So, if you have a huge hiring team and you've frozen hiring, unfortunately, like, that team wouldn't make sense. So the advice on the G&A side is map out all your G&A, assess what is the ROI of each area and each person and each department. And if it's hard to apply ROI for those folks in terms of dollar value, and you really care about efficiency, then changes should be made. As a rule of thumb, as a percentage of revenue, G&A should be around 15 to 20%, 15 for later stage companies, 20 for earlier stage companies. In terms of culture management and messaging, this is all about just bulletproofing your company and your process and your people, and make sure everyone is aligned on the new reality. Unfortunately, interest rates are where they are, valuations have come way down, and the new reality of being focused on efficiency and profitability over time is way more important than just pure growth, which is what it used to be. So everyone's got to understand that. And I think it's also really important to shift the mentality to recognize and celebrate efficiency. And then lastly, cash is king. So we'll talk about budgeting and cash management in more detail in the next few slides, but at a high level, you want to adjust your OpEx to keep your runway over 24 months. It'd be perfect to have a burn multiple of 1, but under 2 is great. And then keep your CAC payback under 12 months, which means you have to adjust and react quite quickly if demand falls off. So we'll spend more time on this in the next few slides, but that's the high level. So in terms of rebuilding this cash management plan, I think it's like the biggest red flag or problem for your company would be we have to raise now and we weren't planning on raising. So step 1 is build a really, really conservative top line forecast. Assess all the metrics of what that looks like. Look at all the OpEx and match the OpEx to that conservative forecast, meaning adjust your OpEx to make sure it makes sense. And then look at your cash runway based on that. And I think that's really important because it is a really tough time to raise. And if you get surprised, it's just a really bad outcome. So be very, very conservative when you're forecasting. David, in the last conversation, talked about a scenario where a company is expected to grow 2x, and then headwinds happen, and that growth rate falls off, and then the metrics fall off, and then the burn multiple goes way up. I'm not going to go into this, but what is important is to focus on the burn multiple today, not the burn multiple once you grow into it. It's very dangerous to assume new revenue growth when it relates to your burn multiple, because if it doesn't happen and then you've hired a team, then your OpEx is way up and you run out of cash much faster. So I'll skip over that. And I'll go to this metrics model that I think will be very helpful. So this is an automated tool that allows you to basically plug in your ARR waterfall and forecast, allows you to plug in your MRR by customer, and it automates a whole bunch of cohort analysis by segment. It automates the ARR waterfall analysis by segment and all of the metrics you care about. So it's broken down into a couple different things. One is top line growth. The next is the unit economics. Next is retention trends, sales efficiency, and burn metrics. And then the benchmarks, what we've done is we've pulled all the benchmarks that are publicly available, and we've put this into the model, and it's automated. So based on your stage and your sell to, all these benchmarks will automatically update. So if you're a later stage company, you'll see the benchmarks that are most relevant for you in terms of top quartile, medium quartile, and bottom. Or if you're early stage, all this is automated. But what this can help you do is you plug in your forecast for next year and you get to see all your metrics. And something that's interesting to call out as I look at this plan, I'd say, okay, well, net dollar is, decelerating. And in the forecast, it's actually going up to levels where it's never really been. So that's something to double click on. And then on CAC payback, it's becoming more inefficient over the last few quarters. And then the forecast is it's going to be way more efficient. And this is risky because if these things don't happen and you expect, based on this forecast, our cash runway is a lot longer than it is, and things change, then you're in that tough scenario where you run out of cash much faster. So what I did is I made some adjustments and I reduced net dollar down and I reduced sales efficiency and I looked at cash balance. This is just a random company, something I just threw together. It's no business that is that's a company today, but hypothetically, in this other scenario, this company runs out of cash much faster than expected when you just change a few metrics. So this is that whole notion of build a very conservative cash plan. And that will help you understand, okay, how much room do we have to miss? And if we don't have any room to miss, we really want to avoid that really downside scenario of having to raise in this tough environment. We need to adjust our OpEx and adjust more now. So we'll send this model out and it's quite detailed. Happy to do a number of follow-up sessions on it if it's helpful. But this is, I think, going to be really helpful. And it's a tool I've used in the past in all my engagements where I've helped companies in the CFO role. So hopefully it's helpful. All right. So those are the 8. And again, maybe not all 8 work for you and match. Ideally, some of them do, and you're inspired to look at a few things, but those are the 8. And look, at the end of the day, I'll just finish with this. Great things are done by a series of really small things. If you can get your whole team to operate at a much more efficient basis, and everyone's aligned on this new world, and everyone's focused on making shifts across a whole number of small things, that ends up being a major shift when you consolidate it all into one. So just wanted to finish with this. And of course, it's relevant because of the recent win, and it's a great photo. So thank you everyone for listening. We do have some time, not as much time as expected, but we have some time for questions. We have 15 minutes. So thanks a lot.
Well, feel free to come off mute or put it in the chat, whatever works for us.
No questions. All right.
Well done, Mike. You did it. Everything's answered.
All right. Well, if anyone thinks of something the next
Here we go. Sorry.
Okay, you got
You're
a
not off the
question.
hook. Do you see the chat, or would you like me to read it?
Well, I can't see it.
I'll read it for you, but just click on chat. Mike, do you think of a minimum ARR threshold for these analysis?
Yeah, it's a good question. I think there is, if you're like still figuring out your ICP and product market fit, then a lot of these analysis don't fully make sense. But I think it's a really good thing to have in mind as you are finding product market fit and thinking about, all right, hey, let's go into this market, and oh wow, this market probably is going to experience a lot of headwinds in the next year and a half. Maybe that's not where we should be focused on. So yes, it is only relevant for companies that have customers and can do the analysis, but I think the thinking is very valuable for everyone.
Great. I put a super quick survey just in here. If everyone can have a very quick look, it's only one question just to make sure we're doing a good job for you all. Any other questions? Here we go. The benchmarks that Craft has in the tool, how many companies make up that population? And wondering if it's a big ask to have the Craft team try to find similar companies to our own to find more relevant benchmarks.
Great question. So in that benchmarking model, which we're going to share, there's a tab that has consolidated pretty much every publicly available source of benchmarks over the last number of years. So A16Z, if you go on their website, they post a whole bunch of metrics and benchmarks. Insight, OpenView. There's about I think 10 sources. So that should help. They're not really by vertical. There are benchmarks by segment, which is helpful. So there's a lot in there. We'll make sure it's a complete list. So hopefully that helps. Don't know if that answered your question, but there's a ton of benchmarks in there. We've really tried to find everything that's available.
Yeah, for sure. I'll just quickly respond. I think the question is kind of like, when you're looking at benchmarks, public companies or even private companies that you have access to that we don't, you're grouping together 1,000 companies at once, and you don't know if they're B2B enterprise SaaS, you don't know if they're D2C. So it can be hard to kind of like, even with the segment analysis sometimes, to know if you're looking at companies that are performing the same way you are. So I'm just wondering if you're reaching out, if we reach out to our Craft team and say, is it possible to look in your own portfolio and say, these 10 companies are a lot similar to yours and these are their benchmarks, anonymized, but just to kind of be comparing apples to apples. I just don't know if that's a huge lift to be asking for that from the Craft team. I don't know.
Yeah, that's so that's not fully available today across all the companies, but it's something I think that would be really helpful for all of Craft companies. So I'm happy to do that. What it requires And I'm actually super happy to do that. I think that would be amazing. What it requires is everyone to share data with us. And basically that benchmarking model, which is very fast and easy to update. You need MRR by customer, by segment, and then you need your P&L and cash flow statement, and you just plug it in and it's done. So very happy to take that. And it just will come down to if folks want to share data. So that's one thing. And then back to your question, these reports within the benchmarking model, we have all the sources, and within the reports, it's not in the benchmarking model, but if you read the reports, it shows you, oh, these are the number of companies that were in this this analysis, and it does break it down by enterprise, by SMB, by mid-market. So it's not perfect. The other thing to call out is the benchmarks are also not perfect because they've changed over time. It was easier to sell in 2021 than it is in 2022. And in 2019, it was also different. So the benchmarks actually show this over time. So I hear you on what you're saying, but I do think it's still really helpful to then just see what are other funds thinking about in terms of what is top tier and where do we stack up versus the average of the top tier quartile across 5 or 6 funds that have reported benchmarks for their portfolio. And that's what the analysis is doing.
And of those 10 sources or whatever you were saying, are they all looking ahead to 2023, 2024 and saying, you know, like the regular 2 times year over year, et cetera, that's, I'm sure, scaling down for 2023 and 24. Have they all made those predictions, or many of them?
Yeah, so they haven't, and that's where it becomes a bit of an art. But what's helpful is in this new paradigm of valuation, where it used to just be growth at all costs, and now it's like unit economics, which are a proxy for like long-term profitability. So what's helpful with SaaS metrics is if you have great LTV to CAC, great CAC payback, great net dollar, and great gross dollar, which are the most important metrics, you sort of know long-term, if you keep doing what you're doing, you will be profitable. So in a way, even though we don't know what the next couple years look like, if you just go back to the fundamentals around, you know, CAC payback is sub 12 months and ratios for, you know, G&A as a percentage of revenue, product and R&D as a percentage of revenue, and S&M should be within this range. And we should be able to grow this amount. It's a helpful reference point. But I think, you know, David shared a tweet that was like 2x is the new 3x. I think investors and across the board are very aware of how hard it's going to be and care way more about great efficiency metrics than they do about growth. So if you're looking at a plan for next year that's like, yeah, we're going to grow 2.5x, but we're going to burn a lot and our metrics aren't going to be perfect, that's way worse than we're only going to grow 75%, but we are so efficient and we can weather this storm.
Did you say the slide deck was going to be sent along with the tool?
Yeah, we'll send the slide deck around as well.
Great. Thanks for the chat today, Mike.
Yeah, and also we'll also go ahead and send out the recording, so we can send out all 3 of those. If you did not RSVP for this, make sure that you email me, because then I won't have your email address in here. So it's sarah@craftventures.com, and I'll make sure to have you on the list.
And lastly, I'll just say that metrics model is very detailed. There's a lot of metrics in there. And when I've gone into helping companies in the past, one of the first things that I found quite helpful was to align the executive teams on, hey, these are the metrics that really matter. And these are the calculations. And this is how you improve them. And this is how they get worse. So in the metrics model, there's a section that explains all of them, but very happy to do a follow-up call on that if it's something people are interested in. So in the survey, we'll figure out a way to collect who wants to do that, but that's something I've done in the past that people did find helpful.
Yeah, same thing. Just email me, Sarah@CraftVentures. Happy to work with Mike to set it up. Any other questions?
I'll come off mute here.
Cool.
Hey, Mike, thanks so much for the talk here.
Hey.
One of the ways we're looking at efficiency in our go-to-market org is on the basis of like bottoms up, what is the activity required of these people? And I was wondering if we had something like that we could filter into this efficiency analysis, like AEs should be able to take X number of calls per week or X amount of talk time based on different motions, whether it's like SMB or enterprise, because that I think is also really helpful. Maybe there's things we want to tinker in our sales process over time that's going to make things more efficient as well. But I want to.
That is awesome that you're doing that. That is that's the right thing to do. And that like controlling sale, you can't control demand, but you can control your sales execution. That's the best way to do it. Activity-based tracking. I think Insight has a bunch of data there, and the craft team is, former operators. So I think we'll be able to pull together some stuff to help you think about that. And I'll ask the team internally. The metric model doesn't have that, by the way, just to answer your question.
Yeah. I really appreciate that. I mean, I've naturally been in Salesforce. I have like different perspectives on what is doable versus not doable, but benchmarks on that would be really helpful beyond just orgs I've been in.
Totally.
Thank you.
Thanks, Aaron. All righty. Well,
All right. Thank you.
Give you back 6 minutes. And thank you everyone again for joining, and Happy New Year, and excited to work with all of you over time.
Thanks, everyone.
Thanks, Mike.
Thanks, everyone.